Good afternoon, everyone. I'm Sia Ashish Jain, the moderator of this webinar. We are delighted to welcome you all to this webinar, which is being organized by the Continuing Professional Education Committee of ICI. Please block your calendar for CP webinars on Wednesdays and Fridays. It is my pleasure to be a moderator for this webinar on trust registration and anti-avoidance provision in international taxation. In a short while, we will start this webinar. First, I would like to appraise you about the CP committee. In today's ever-changing professional scenario worldwide, the biggest challenge the professional face is how to stay on the top of their game while adapting to new requirements and norms. Therefore, it is imperative to aim to be up to date to offer unique guidance, influence others with their innovative approach and expertise. It is also vital to stretch old ideas beyond traditional boundaries to create new perspective. In, in this context, continuing professional education facilitates professionals to maintain, improve, and broaden their knowledge, skills, and expertise required to achieve their professional goals through webinars, seminars, etc. The program for this evening consists two session. First is trust registration changes and challenges. Second one is anti-avoidance provision in international taxation and overview. Our eminent speakers will talk about the above mentioned uh, session emerging area of professional interest. Now I would like to introduce our chairman, sir, C. Satish Gupta, sir, who's the dedicated to our profession and giving new ideas to uh, ju- properly knowledge. C. Satish Gupta sir is presently serving as chairman of the Continuing Professional Education Committee of the Institute of Chartered Accountant of India. In addition to this role, he is also the chairman of UDIN Directorate and vice chairman of the Committee for Member in Practice for the current terms. Previously, during in previous tenure, 2019 to 22, he was the chairman of CSR Committee and vice chairman of Direct Tax, PDC, and Committee for Management Accounting. Now, request to Satish sir kindly uh, take the mic and give the welcome address. Over to
Thank
Satish.
you, Ashish. Thanks a lot. How are you?
Thank you, sir. Fine, sir. Fine.
Thank you. And we have today amongst us learned speakers. We have with us the secretary of the CPA committee who is working day and night, my brother Tiwari ji, another team CPA committee, team technical who is taking care of this webinar. And all my dear friends who are attending such a large number, this our Friday event of webinars series out one of the webinar in the series of Friday webinars. Welcome to each one of you. Friends, as rightly told by Ashish that at CP committee, we are taking care of how to organize effective CPE program for our members at large. This year, we have taken two oaths. One, quality of the program, and second, availability of the program. And we are working a lot in these directions. One thing I would like to share that recently our committee has issued a CPE event calendar. And I would like to tell each one of you that calendar has been welcomed by all the branches. I have received several calls from the chairman of the branches, from the conveners, that this is wonderful effort or initiation of the CP committee, which is giving us a thought that how many we can choose any topic of any subject on which they or branch or the CP chapter may conduct the CP program. Apart from this, we have also given them a 100 CP hour program so they can make their CP calendar of the entire year, mentioning there that yes, we want to organize 100 CP hour. So these topics at large, they may take. So this I'm thankful to committee for uh, understanding the need and for approving that particular initiation and releasing the calendar on the day of 1st July, that is the CA day. And I think this will go long way. And the members and the branches and the chapters or the circles will be in position to do as much as the CP program. Second thing, friends, I am on even on the cost of repetition. I would like to say you people that now we are in this CP credit program from last 20 years. In India, 18 years of age is entitled for both. 18 years of age of female is entitled for marriage. And we have crossed the 20 years of the CP credit program. And now the time has come just to endorse our maturity as far as CP program is concerned, that we bring the real-time attendance program in CP. So we plan this year, almost after September, we are going to implement this real-time CP credit attendance program for CP credits. And you will love definitely, because that will ensure the attendance, that will ensure the presence, that will ensure the quality of the program also. In this, we are taking the help of technology, and with the help of geofencing, we would just take every 30 minutes, our system will take credit of your presence, and only real credit will be allowed. So with this, friends, I think you would love this. Apart from this, we are also working that how we can bring availability of the programs to all the members, even to the last member of the institute who is living in the remotest corner. For this purposes, friends, our committee is working very hard to open as many as chapters, as many as circles, as many as groups, to enabling our members to hold the CP program at their own. We are also going to prepare a faculty bank. We have given you the topic calendar. You can choose the topic, you can choose the faculty by visiting the CP site, and you can organize the program. So I would request each one of you that wherever you want that chapter should be created, chapter should be installed. We are ready for that. You just give a letter to the CP committee, and Ajit ji would take that initiation and would immediately respond to your letter. And I think we can open as much any chapters or the circles or the groups of the CP in the entire country. Friends, I would like to tell several things about the other committees also where I am heading or I am the vice chairman. Few things about the UDIN. In UDIN, friends, we need your suggestions that we have made compulsory, that it is going to come very soon. I think from September onward that no member would be eligible to generate 61st UDIN for his quota of tax audit. On the 60 audit, after completing 60 tax audit, no member would be in position to generate the 61st during for the 61st tax audit. So this we have implemented, this has been approved by the council, and we are going to effectively implement from the September onwards. Second thing, friend, which we are, I think that will be very helpful to you all, that in several cases, you are not in position to know the name of succeeding auditor. Suppose an auditee does not pay your fees and change the auditor, and the auditor does not intimate you about his appointment, then in that case, you are not in position to know the name of succeeding auditor. What we have done in the UDIN with the support of council has already approved this, that now onward, with the help of UDIN, you can know the name of succeeding auditor in case the auditee has changed your firm and has gone to another chartered accountant. So in that case, if you have any technical objection or if your fees is unpaid, you can contact with that particular chartered accountant. With this, friends, we in CMP, we have launched our well anticipated course, well awaited course on the GST litigation. This is a 6-day course or 6 hours a day, 36-hour workshop, I would say it is workshop. And I think after attending this course, your confidence in attending GST litigation will be on very high. So with this, friends, I don't want to take much of your time because the time is of the speakers and they are here to deliberate what they thought about the trust. One speaker will speak on the trust registration part, and another speaker will speak about the international taxation part. I think both the topics are very important. Both the topics are, I think, are the opportunities for several members. So please join it, please attend it, and I would like to say that don't forget to attend our webinars on Wednesday and Friday, 4 to 6 p.m. So you just make your calendar fix every Wednesday and every Friday, 4 to 6 p.m. to attend the webinars organized by the CP. We are going to take care that how we can introduce the opportunities in foreign countries. How can we introduce you about the opportunities in the industry sector, specific industry sector? How can we introduce you about the opportunities in the government schemes? And how can we introduce you about the other important, whether regular sectors or whether other important topics. So we will bring several other topics for your knowledge, and I think you would love in the same way which you are loving us. Thank you very much. Thanks a lot for giving this opportunity. Thanks the team. Thanks Ashish. Thanks Ajit Bhai. And thank the speakers for attending. And thank you, my dear member, for attending such a large number today's webinar. All the best. And I think I'm in a meeting. I have come out of that meeting today for meeting with you people through this webinar. So I would seek your exemption from attending this webinar furthermore. Thank you. Thanks a lot for all the.
Thank you very much, sir.
Thank you, Satish sir, for your great initiative regarding continuing professional education and Udin director. Now,
okay, thank you, Ashish. Thanks a lot. Ashish is also a speaker, Ajit Bhai, on the MSMEs.
Okay, sir.
You also note down his name and give
Right,
him
sir.
He's a wonderful speaker and having a wonderful knowledge over that particular.
Thank you, sir. Thank you so much. Now this is time to start our session. First session is trust registration changes and challenges by CA Chunoti H. Dholkia ma'am. She has written multiple articles on income tax, GST, etc. for various newsletters, journals and newspapers. She has served as a faculty in seminars organized by Bhuj branch and Gandhidham branch of WIC of ICI. She is also authored and co-authored books on tax planning practical aspects, all about trust and NGOs, export promotion measures in India, handbook on taxation of private trust of Income Tax Act 1961 extra. Now I welcome to Chunoti ma'am. Please start your session, ma'am. Over to ma'am.
Thank you, Ashish Bhai, and thank you, CP committee, for giving me this opportunity. Today we will discuss trust registration, changes and challenges, and other key updates. So, first we will see process of registration of trust under Section 12 and 80G. Then we will discuss issues in registration of trust under Section 12 and 80G. Then we will discuss the amendment made under the new income tax bill related to trust. And then we will see whether the new format of financial statements is applicable to trust also or not. So, as we all know, Section 11 and 12 and 13 of the Income Tax Act are complete code in itself, and registration under Section 12 is mandatory to exemption under Section 11 and 12. And many trusts have been made provision related to trust in last 4 years, and there are drastic change has been made in process of registration, and now there is no permanent registration under Section 12 and 80G. The trust has to apply for provisional registration, which is granted maximum for 3 years, and the regular registration has been granted maximum for 5 or 10 years, subject to some conditions. What are the some conditions? We will see it later. With effect from 1st October 2023, the trust can directly apply for regular registration subject to satisfaction of some conditions. Now the question comes, who can apply for registration in Section 12A? Section 12A uses the word any trust or institutions. Hence, any public, charitable or religious trust can apply for Section 12A registration. The private trust cannot obtain registration under Section 12A, and cooperative society and Section 8 company can obtain 12A registration. Now the question is, who can apply for registration under Section 80G? As we all know, that only charitable trust can obtain Section 80G registration, and religious trust cannot obtain Section 80G registration. And the trust having charitable and religious trust can obtain registration under Section 80G, but subject to the conditions that expenditure on religious nature of such trust has to be less than 5% of total income of the trust. If the trust has expenditure on religious nature more than 5% of total income, the trust cannot obtain Section 80G registration. And as we all know, after implementation of Income Tax Act 1961, the trust cannot have charitable as well as religious objects. The trust can either be formed for charitable purpose or for religious purpose only. And for 80G registration, objects of the trust should not be related to particular religious community or caste. Now, when we have applied for registration under Section 12A or 80G, two main conditions are important. Main focus of the CIT is on charitable objects as well as genuineness of activity. Now, what are the charitable objects? Section 215 defines charitable objects as relief for education, yoga, medical relief, preservation of environment, preservation of monuments or places of objects or artistic or historic interest, or advancement of any other object of general public utility. Such objects should not be related to particular religious community or caste or particular group of members, and the object should not be related to conducting any activity related to trade, commerce, or business. Now coming to genuineness of activity. What is genuineness of activity? Genuineness means activity conducted by the trust should be as per objects mentioned in trust deed, and actual activity should be conducted by the trust only on charitable nature only. Charitable nature, as we have seen 215, and conditions of 215 shall be followed, as well as activity of the trust should be genuine in nature. Now coming to the due dates. For the due date of filing application for registration under Section 12A, the trust has been bifurcated into 6 categories. First category are the trust which has obtained old registration under old provisions. The trust were already registered under Section 12A under old provisions. The trust has to apply within 3 months after implementation of new provision, and this date was extended till 30th September 2024 by circular number 7/2024. Second category are the trust which has obtained regular registration. If the trust has obtained regular registration, such trust has to reapply for renewal of registration at least 6 months prior to date of expiry of such registration. For example, if the trust has obtained regular registration from assessment year 22-23 to assessment year 26-27, such trust has to apply for renewal of registration on or before 30th September 2025. Third category are the trusts which has obtained provisional registration. Such trust has to apply for regular registration at least 6 months prior to expiry of period of provisional registration, or within 6 months of commencement of its activity, whichever is earlier. For example, if the trust has obtained provisional registration from assessment year 25-26 to assessment year 27-28, and the trust has commenced its activity from 1st April 2025. Such trust has to apply for regular registration at least 6 months prior to expiry of provisional registration, that is, on or before 30th September 2026, or within 6 months of commencement of activity, that is, on or before 30th September 2025, whichever is earlier, meaning thereby the trust which has commenced activity on 1st April 2025 and has obtained provisional registration only has to apply for regular registration on or before 30th September 2025. Fourth category are the trusts which has obtained 2023C registration. The trust which has obtained 2023 registration are valid registration, but after expiry of the period of validity of registration, the trust cannot apply again under Section 1023C, but the trust has to apply for registration under Section 12A in this clause 4 at least 6 months prior to the commencement of the assessment year from which the said registration is thought to be made operative. That is, trust if such validity of registration of such trust expires from assessment at 26/27. The trust has to apply under Section 12A on or before 30th September 2025. Fifth category are the trust which has modified its object. The trust has to apply for registration within a period of 30 days from the date of the said adoption or modification. And last category, in this category there are two types of trust. First type of trust which has not commenced activity at the time of applying for registration. Such trust has to apply for registration at least 1 month prior to the commencement of the previous year relevant to the assessment year from which the said registration is sought. And the trust which has already commenced its activity before obtaining registration, such trust can directly apply for regular registration at any time after the commencement of such activity, provided benefit of exemption under subclause 4, 5, 6 or 6A of section 1023C, section 11 or 12 has not claimed in any previous year ending on or before the date of such application. For example, if the trust has commenced its activity on 1st September 2025, such trust can obtain registration at any time in the financial year 25-26, but with the condition that the trust has not claimed section 11 or 12 exemption in any of the previous year, in previous year 24, 25, 23, 24, any previous year. If the trust has not claimed section 11 or 12 exemption, then only the trust can directly apply for regular registration. Otherwise, the trust has to first apply for provisional registration and then the trust can apply for regular registration. Now, similar conditions are there for Section 80G registration. We will not repeat it here, but there is one small difference for the trust which has already commenced activity before applying for registration. The trust can directly apply for regular registration at any time after the commencement of such activity. Now, coming to period of validity of registration, there is one change in period of validity of registration, and is specified under the Act. If income of the trust is less than rupees 5 crore in last 2 previous years, validity of registration will be for 10 years. Otherwise, it will be for 5 years only. If income of the trust is more than rupees 5 crore without claiming section 11 or 12 exemption, that is gross income of the trust should be considered. If gross income of the trust in any of the last 2 previous years, suppose income of the trust in previous year 24-25 is 4 crore and in financial year 25-26 it is 5.5 crore, validity of period of registration will be 5 years only, because if the trust has income more than 5 crore in one previous year. But there is one exception, that if the trust has directly applied for regular registration, validity of period of registration will be 5 years only, irrespective of the income criteria which we have discussed already. Now, here there is one misconception, that the period of validity of registration is automatically extended and the trust need not apply again for registration even after expiry of the period of registration. Validity of period of registration, if the trust has obtained registration for 5 years, it will be automatically extended for 10 years. But this is not the case. Actually, the trust has first applied for registration under relevant category, and after verifying the documents, objects and genuineness of activity of the trust, CIT will grant registration for 10 years or 5 years considering the income of the trust. And period of validity of registration under section 80G is 5 years only in all cases. Here the income criteria is not applicable and it is granted only for 5 years. Now, the question is, when registration under section 12A will be cancelled? In some circumstances, registration under section 12A will be cancelled. These are considered as specified violations. What are these? We will see. First is income applied other than for objects of the trust. or if the trust has income from profits and gains from business or profession which is not incidental to attainment of trust objects, or separate books of accounts are not maintained for the business incidental to trust object. For example, if the trust has intentionally conducted the activity to earn profit. Here the word is intentional and not incidental. If the trust has intentionally conducted any activity to earn the profit, income from such activity will be treated as business or profession income. But if there is no intention to earn profit from the activity, but the activity is incidentally conducted to attain the trust objects, income from such activity will not be treated as business or profession even if the trust has earned profit from such activity, but subject to the condition that the trust has to maintain separate books of account for such activity only. Another circumstances is that if the income applied for private religious purpose or income applied for benefit of particular religious community or caste, or if any activity of the trust is not genuine or not carried out in accordance with all or any of the conditions subject to which it was registered. If we have seen the certificate of registration under section 12A, it is mentioned that this registration is granted subject to the conditions mentioned in Annexure A, B, or C of Circular number 1122 dated 30th June 2022. If the trust has violated any of the conditions mentioned in this circular, registration of trust will be cancelled. Another circumstances is violation of provision of any other law. If the trust has violated provision of, suppose, GST law, registration of application will be cancelled. Or if the application of registration contains false or incorrect information, registration will be cancelled. Now coming to renewal of registration. As we all know, all trusts whose registration is valid till assessment at 26-27 has to reapply for registration on or before 30th September 2025. Hence, it is advisable to file application in advance and get ready tentative reply of notice and all document in advance. Here, as we all know that there is change in section and validity as per new Income Tax Bill 1025. Section 12A is replaced with Section 332 and Section 80G is replaced with Section 354. Hence, if the trust has granted registration under Section 12A in Income Tax Act 1961, it is valid under new Income Tax Bill under Section 332. And if the trust has granted registration under Section 80G, it is valid under Section 354 of new Income Tax Bill 2025. And as we all know that for the validity of registration, the assessment year and previous year concept has been replaced with tax year in new income tax bill. Hence, if the trust has obtained registration up to assessment year 31-32, it will be valid up to tax year 31 under new income tax bill. We should note this change because in future it will be useful. And as we have discussed earlier, no new renewal for registration under Section 1023C. The trust has to apply for re-registration under Section 12A under Code 4. Here, many trusts are facing one common issue, which is application for registration has been rejected due to the reason only the status of registration has not been updated under exempt institution tab. Under the Income Tax India portal, there is exempt institution tab in the Income Tax India portal, and registration status has been disclosed in this tab. But due to some, it happens in some cases. Suppose the trust is applied for provisional registration. After some time, due to some reason, the trust is surrendered the registration and reobtained provisional registration. But at the time of applying for regular registration, application for registration has been rejected because the status of surrendered registration has been shown under exempt institution tab. But the registration obtained again is not updated on the portal. Similar issue was faced in Dr. C.J. Desai and Jaswantiben Desai case. In this case, ITT Ahmedabad held that application for registration shall not be granted only due to the reason that status of registration has not been updated on the exempt institution portal. But to avoid this situation, we should consider that before applying for regular registration, we should first check status of registration under exempt institution tab. It is useful for donors as well as trust, because the donor who has given donation to trust can check actual status of registration whether the trust is registered under section 80G or not. Similarly, suppose the trust has given donation to another trust which is registered, but status of registration has not been updated on the portal. And due to this reason, the trust may not claim 85% of application of income for the donation given to such registered trust. Hence, to avoid this situation, we should check status of registration. Now, coming to valid evidence. When we receive a notice after applying for regular registration, we are attaching generally ledgers for expenses on trust objects or vouchers. In some cases, it has been observed that the vouchers are handwritten and not printed on letterhead of the trust, and it is sometimes unsigned. This is not treated as valid evidence even by tribunal or other judicial authorities. Hence, we should always submit printed vouchers on the letterhead of the trust, and sign should be there of trustee and with stamp of the trust. And along with this voucher, we should submit bills and confirmation from pay, news related to trust activities published in newspaper, photographs of trust activity, and pamphlets to inform public about any specific event or activity of the trust. These evidence are treated as speaking evidence, that is valid evidence, and on the basis of this evidence, registration has been granted. Now, what if application for registration is not filed within specified time? There is one remedy. If the trust is applying for regular registration after obtaining provisional registration under section 12A, and if the trust has not claimed benefit of exemption under section 11 or 12 in any earlier previous year, the trust can file application under clause 6B. Otherwise, the trust has to file application under subclause 3 with delay condone application. In case of renewal of registration, the trust has to file application under subclause 2 with delay condone application. Similar provision is applicable for 80G registration, but there is no delay condone powers in case of renewal of registration, and delay condone power has not been given for section 80G registration also. Hence, for 80G registration, all application has to be submitted on or before due date of filing application. And this is applicable in case of delay in filing application and not in case of rejection of application. And as we have seen earlier, principal CIT or CIT has given power to condone the delay. If there is reasonable cause for delay in filing the application, they can condone the delay. But what is reasonable cause? Reasonable cause means genuine reason. If the trust has genuine reason to file the application with delay, the registration application shall be condoned. But there is no power to condone the delay in filing application for registration under section 80G as we have seen earlier. And now there is option to file the delay condone application along with the filing of application for registration as being given on portal. The trust can select condonation option and submit the supporting documents such as affidavit or another supporting document regarding delay condone, and by giving reason for delay in filing application under this clause, the trust can file application for delay condone along with filing application for registration. Now, what is the remedy if application for regular registration or renewal is rejected? If only application for regular registration is rejected or renewal is rejected, the trust can file application again under clause 6B, that is directly apply for regular registration. But if application for registration is rejected by giving reason that suppose the trust has not objects which are charitable in nature or activity of the trust are not genuine. In this case, even if the trust is applying under any of the code, application for registration is rejected because the reason remains same. Hence, in this case, only remedy is with the trust is to file an appeal with the tribunal. Similarly, if application for regular registration is rejected along with cancellation of provisional registration, in this case, if the benefit of exemption under section 11 or 12 is not given by the trust can file application under subclause 6b. Otherwise, the trust has to file an appeal. But we should consider that this is not a thumb rule. It is not applicable in all cases of rejection. First, we should check the reason for rejection and then should apply our mind whether file to appeal or whether to file application again under relevant clause. Now, what are the consequences of rejection of application under section 12 and 80G? As we all know, benefit of exemption under section 11 and 12 will not be available and the trust will be treated as AOP. And if provisional registration is also cancelled and filing of return of earlier assessment is pending, it will be filed as per AOP and not as registered trust. And there is one very harsh provision, that is section 115TD. If application for registration under section 12A is rejected, provision for section 115TD will be applicable and the trust will be assessed as per its accreted income. The trust has to pay tax on its accreted income, that is this is very harsh provision. Hence, to avoid this situation, applications should be filed within time and by providing supporting all documents. And if application for registration under section 80G will be rejected, donors cannot claim deduction under section 80G for donation given to trust. Now, one question is that whether application for renewal under section 80G will be rejected if Form 10BD is not filed in any previous year. Generally, the application shall not be rejected under section 80G in this case because it is nowhere mentioned in section 80G that application under section 80G will be rejected if Form 10BD is not filed within any time in any of the previous year. But it is duty of the trust and it is compulsory that Form 10BD shall be filed by the every trust who are registered under section 80G. Now, there are many reasons for rejection. Main reason for rejection of the trust is first is name of trust having reference of any particular religious community. It is specified violation under section 12A before if the trust is established after commencement of this act and has applied any part of income for the benefit of particular religious community or caste. But what if name of the trust contains reference of any particular religious community but objects are related to general public? To answer this question, we should divide the trust into three categories. First category are the trusts which were established on or before 1st April 1962, that is before implementation of Income Tax Act 1961. Second category are the trusts which are established after 1st April 1962 but before 1st April 2021, that is before implementation of new provision of registration of trust. And third category are the trusts which were established after 1st April 2021, that is after implementation of new provision. For the first category of the trust which are established before 1st April 1962, provision of particular religious community is not applicable, hence registration shall be granted to this trust. For the trusts which were established after 1st April 2022, it is mandatory to follow these conditions, and if they have not followed this condition, application for registration will be rejected and it will be treated as specified violation. But for the trusts which are established after 1st April 1962 but before 1st April 2021, there are mixed judgments given by judicial authorities. Some judgments are in favor of SSC that registration shall be granted, and some judgments are in favor of revenue that registration shall not be granted. ITAT Ahmedabad directed in case of Sindhu Seva Samiti versus CIT exemption that Actual activity should be verified for registration and not any word in name of trust indicating any particular religious community. This registration was granted in favor of SSE. Another judgment given by same judicial authority in case of Pojalram Leva Patel Seva Samaj Trust versus CIT exemption. In this judgment, it was held that Section 31B would be attracted at the time of assessment and not at the time of grant of registration. This judicial pronouncement was also given in favor of SSC, but the same authority, ITAT Ahmedabad, case of Shri Saudharma Brihat Tapogachya versus CIT exemption, ITF 1571, that Section 13(1)B requires to be in conjunction with the provisions of Section 11 and 12 toward determination of eligibility of trust to claim school for benefit of general public applied for registration under Section 12A. Application for registration was rejected by CIT and applied Section 13(1)B. ITAT Ahmedabad held that subject are otherwise charitable is a valid trust for the purpose of grant of registration. Hence, provision of Section 13(1)B of the trust are applicable only at the time of determination of eligibility of exemption under Section 11 and not at the time of registration. Now, there is one interesting judgment given by ITAT Bengaluru in case of Sri Shriti Parampara Gurukulam Bengaluru versus ITO. In this case, the trust was providing Vedic education. Registration the religious trust category and application for registration under Section 80G was rejected on the ground that spreading knowledge of Vedas is religious object and therefore it is formed for the benefit of particular religious community. ITAT Bengaluru held that Hindu is a way of life or state of mind and not a religion. The word Veda means knowledge and it is derived from the word Vid, means to know. Vedas contains knowledge of science, medical, political science, etc. Hence, it cannot be confined that Vedas are belonging to a particular religious community and the activity of spreading Vedic education is charitable and not religious. Hence, registration under Section 12 and 80G shall be granted under charitable trust category. Another reason is expenses of religious nature, which we have discussed earlier. For this reason, there is an interesting judgment recently given by Bombay High Court in case of CIT exemption versus Sri Sirdi Sai Baba Devasthan Trust. In this case, the trust has obtained registration under Section 80G, but the trust has some anonymous donation. Revenue applied Section 115 BBC on the anonymous donation on the ground that the trust is solely charitable trust falling within the purview of Section 80G of the Act. Because the trust has obtained 80G registration, the trust is charitable and not religious, and Section 115 should be applicable. This was the view of revenue. But the Bombay High Court held that there is no power for a charitable trust to be a religious trust. Section 80G allows for institutions that are engaged in limited religious purpose if expenses on religious nature does not exceed 5% of total income. And as in this case, expenses of religious nature were less than 5%, Section 115 BBC is not applicable in this case. Now, another reason is expenses in the nature of trade, commerce, or business. There is one landmark judgment which was given recently before 2-3 years by Honorable Supreme Court in case of SCIT exemption versus Ahmedabad Urban Development Authority, through which judgment concept of predominant object has been removed. Hence, even if the trust has main object of charitable nature, but the trust has carried out other activities which were in the nature of trade, commerce, or business, the objects will not be treated as charitable in nature, even if main object is charitable. And we have seen Section 215 proviso in which it is mentioned that if the trust has conducted any activity for a fee cess or consideration and the trust has any other object of general public utility, it will be treated as trade commerce of business if such activity is not conducted in the course of actual carrying out of advancement of any other object of general public utility and received from such activities more than 20% of total receipt. But what is the meaning of in the course of? In the course of means as a part of or connected to. Hence, any activity which is conducted for fees, cess or consideration is not part of actual carrying out of any advancement of other object of general public utility. It will be treated as trade, commerce or business. Now, in case of medical or educational institution, profit from business activity should be close plus marginal markup only. If the such trust has conducted any activity more than cost or marginal markup, it will be treated as trade, commerce or business if income from such activity is more than 20% of total receipt. Now, how to decide what is trade, commerce or business? To answer this question, first we have to answer two questions. First is whether activity conducted for a fee, cess or consideration. If yes, whether such activity is conducted at cost or marginal markup. If no, then the activity is treated as trade, commerce or business. Meaning thereby, any activity which is conducted for fees, cess or consideration shall be conducted only at cost or marginal markup. If activity is conducted more than cost or marginal markup, it will be treated as trade, commerce or business. Some practical examples are explained. If the trust has owned shops and offices and the trust has given it on rent, whether the rental income of the trust is treated as trade, commerce or business. If the rental income is at cost or marginal markup, it rent of the shop or office it cost at cost or marginal markup, then no issue. But if it is more than cost or marginal markup, it will be treated as trade, commerce or business if total receipt from rent is more than 20% of total receipt of trust. Similar rule is applicable for paid workshop, training classes, skill development course, etc. In case of medical store managed by a hospital, suppose a trust is maintaining a hospital and also maintains the medical store which is connected to the hospital. The trust shall always consider in this case that income from medical store should be at cost or marginal markup as we have seen earlier, and the trust has to maintain separate books of account for such activity if income of the such activity is more than 20% of total receipt. Now we will see some judicial rulings related to notice. In case of that Bechar Das Manchand Jain Svetamba Trust versus CIT exemption, ITIT Pune held that notice mailed on wrong email ID is not an effective notice and violates the principle of natural justice. Hence, opportunity should be given to the trust by serving the notice on the registered email ID. When we are applying for regular registration or renewal registration, the notice has been served by CIT exemption, for which we have to give the reply. And if the notice is not mailed on wrong mail ID, correct mail ID, and physical copy is also not sent, it will not be treated as valid notice, and registration shall not be cancelled only due to the reason that the reply of notice has not been given. Another same judgment was given in case of Sant Kabir Mahasabha versus CIT exemption. In this case, ITIT Chandigarh held that merely uploading information about date of hearing on the income tax portal is not the effective service of notice as per provisions of section 282 of the Act. Hence, CIT shall serve the notice physically as well as on the registered email ID and decide afresh for application for registration. Now we will see what are the amendments made under the new income tax bill which are related to trust. We will see highlights only. As we all know, separate part B is inserted in a chapter which covers section 332 to 355, which are specifically related to registered non-profit organization. In the Income Tax Act 1961, the word used was trust or institution. In some section, the word used trust. In some section, the word used were institution. Some section refers hospital, educational institutions, medical institutions, etc. But here, the only word used is registered non-profit organization. There was some misconception that if the trust is used and institution is not used in some provision, it is not applicable to another relevant trust or institution. But to avoid this situation, the only word is used is registered non-profit organization, and hence all provisions in section 332 to 355 is applicable to all registered non-profit organizations. And as we have discussed earlier, section 12A is covered in section 332 and section 23C is removed. And provisions of ATG is replaced with section 133 and 354. Now there is two sections. The donor can claim deduction under section 133 if the trust has obtained approval under section 354. Hence, the trust has to get approval under section 354, and in those cases the donor can claim exemption under section 1. Now the definition of charitable purpose is given in section 223, which was given earlier in section 215. And the time limit for filing application for registration, time limit for passing order, and validity of registration is explained in tabular format in Schedule 3. Hence, it is very easy to understand these provisions. Now, there is some new insertions and replacement of terms in income tax bill. List of non-profit organization which can obtain registration is given under section 332. In old act, only the term any trust or institution was used in section 12A and no trust were described. But in the new bill, it is specifically defined which trust can obtain registration under section 332, and there are special provisions related to switching over of regime which has been inserted. Now the income of the trust has been divided under four categories: regular income, taxable regular income, specified income, and residual income, which were specifically defined. What are these terms? It is also specifically defined under the new bill. And now the term deemed corpus donation has been inserted, and the word maximum marginal rate, which was used in Income Tax Act 1961, it is replaced with specifical 30%. Also, definition of some words, including cancellation, registration, commercial activities, specified assets, are given in section 355 by inserting separate part under the heading interpretations. Some terms which were not defined in the old act are defined in new act. Hence we have is in understanding what are the cancellation, registration, commercial activity, etc. Now we will come to our last topic, that is applicability of new format of financial statement to trust. As we all know, ICAI has given guidance note for financial statement on non-corporate entities. In this guidance note, it is mentioned that entities for business, commercial, or other economic and social activities can be established under variety of structures, and the most common structures are as follows. In the clause F, it is mentioned that trust, private or public, registered under any law for the time being in all trusts which are registered or unregistered and private or public are covered, but there is one exemption in applicability of new format, which is that the new format will not apply if format is already prescribed under Public Trust Act or if the trust is not conducting any commercial activity. Hence, for the public trust for which the new format is prescribed under the Public Trust Act, new format of financial statement is not applicable, or the new format is not prescribed, but the trust is conducting activity which are commercial in nature. Suppose the trust is conducting activity which are specifically barred by provisions of section 215. In this case, it may happen that the format of financial statement will be applicable because the trust is running commercial activity. Now there is one special case, educational institutions. Educational institutions have their own prescribed formats of financial statement issued by ICAI and are not required to follow the general format. Before some years, the ICAI has given special format for educational institutions, and educational institutions are not required to follow financial statement or non-corporate entities. This is from my side. If there is any question, then welcome. Otherwise, thank you. Thank you so much.
Thank you, Chunoti ma'am. There is some questions raised by the audience. Mr.
Yes.
Ambalata Rasu, Chennai asked the question. Uh, the trust is having registration under Section 12A up to assessment year 26-27. Due date for filing Form 10AB will be on or before 30th September 2025. But if we see the online form, under income details, serial number 26 of Form 10AB, it is asking for details for financial year 25-26, which is not possible. Kindly advise as to what figure need to be filed up on the same.
If the trust has figures up to the date of filing application for the registration, the trust can file such figures. Otherwise, the trust can mention that as the financial year has commenced just now, the trust has not available the details with the signature of the trustees, and only provisional data with the signature of trustee can be submitted. It is allowed.
Mr. PC Bansali Jaipur is asking a question. Whether Devistan Vibhag Rajasthan registration is necessary to get permanent registration under Section 12A and ATG for a charitable trust, and if applicable application is rejected on this sole ground, that then what is remedy?
For which trust?
Uh, Devistan Vibhag Rajasthan registration is necessary to get permanent registration under Section 12A and ATG for a charitable trust. And if applicable application is rejected on this sole ground, then what is remedy?
If the trust has income which is more than maximum limit, which is not taxable, the trust has to apply for registration under Section 12. It is mandatory. If it is religious trust, the trust can apply under religious category under Section 12A. Otherwise, if the income is less than the maximum income which is allowed as exempt, it is not necessary to file application for registration under Section 12.
No, ma'am. Basically, question is asked by the Bhansali Saab. Uh, Registration under Section 12A and ATG rejected on the sole ground that Devistan Vibhag Rajasthan registration is not available on the application. Then what is the remedy for the applicant for this rejection?
The trust can file appeal if
Okay.
the trust is something. Yes.
CA Ankita Single Rampur, she is asking one question. One of my client trust got the provisional registration for 3 years up to assessment year 24-25. But they forgot to reapply registration within the time frame. Now, what they can do, which form can be used for reapplication?
The trust can file delay condone application. There is option given in the portal. The trust can select condonation option. 10AB form shall be selected, and a provisional registration is the trust has obtained provisional registration. The trust can apply under code 3, 12AB 1AC 3. The trust can apply under Section 183 by submitting delay condone application by giving reason for delay and submitting supporting proof such as affidavit or another proof which is available with the trust. The trust can submit the application in this way.
CA V Srinivasan Krishnagiri asking any changes in the format for financial statement?
Yes, financial statement format for trust is applicable if the trust is conducting commercial activity. Otherwise, as the format is prescribed by particular Public Trust Act, the new financial statement format for non-corporate entity is not applicable to trust.
Thank you, Chunoti ma'am. This was a wonderful session where we heard about type of registration, type of trust, genuineness of trust, registration of trust, validity of registration, cancellation, conditions of registration, renewal of registration, and remedy for rejection of trust, and new amendments also. Thank you so much. This was wonderful session. Now
Thank
I
you.
want to introduce for second session Mr. B.B. Satyamurthy sir. He has over 12 years of experience with deep expertise in direct tax, international taxation, and transfer pricing, along with practical exposure to audits under IFRS and S and Indian GAAP, as well as tax litigation, compliance, and due diligence. He is a regular advisor on corporate and international tax matters, including representation before tax authorities and guidance on UAE corporate tax. He has delivered multiple sessions at uh, ICI forum and faculty for ICI certificate course on UAE corporate tax, actively contributing to professional learning and development. Now I want to invite CA BB Satyamurthy sir, kindly guide us about anti-avoidance provision in international taxation and overview. Over to Satyamurthy sir.
Thank you, Ashish. I'm just confirming that I'm audible.
Yes sir, yes sir.
Yeah. And I will just share my screen also once. Yeah. This works, right? You are able to see the screen, right?
Yes sir. This
Correct,
is
sir. You can
visible.
done.
Yeah, sure. And I will just get started with the discussion. A warm welcome to everyone for this discussion. So we will just go through the certain anti-avoidance provisions that have been incorporated either in the Domestic Income Tax Act or in the double taxation avoidance agreements. We call it generally as treaties. We will just go through an overview of these. While one may or may not be an expert in international taxation, it is quite important for everyone to be aware of these basic provisions, so that since this will have interplay in various other structures that they do. Unlike the past decade or the years of the past, where only large companies had multinational presence, now even a small startup generally tend to have some business connection, some interconnection with the that are across the world. So this becomes important that everybody has an overview of this topic. So there has always been a classic debate as to what constitutes tax planning, what constitutes tax avoidance. In judiciary over the years, it has been held that any assessee who is chargeable to income tax can always plan in such a way that he is able to pay minimum tax, as long as whatever the planning that he does is within the four walls of what has been prescribed in the Income Tax Act or other legislations. In this background, on the other hand, it becomes increasingly complex for the tax authorities to ensure that there is no tax avoidance attempts made by the taxpayers. So I will just give you an example for in international tax context. What used to happen is that say, for example, I'm an entity, I'm a overseas investor, and I would like to make some investment in India. In this example, the India has entered into DTAA or tax treaties with various countries, and each countries have different provisions. Say, for example, if you take India and US treaty, the tax rate applicable for dividend is 15%. The domestic tax rate is 20%, and if you take India-Colombia treaty, the tax rate applicable for dividend is 5%. So any person, they may be tempted to establish an entity in Colombia and then make the investment in Indian entity through that Colombian entity, because they will be able to enjoy a tax rate of 5% on the dividend that they will be receiving from this entity that they've made in India, as against 15% if they do it from US, or if assume a country where there is no treaty between India, then it could be 20% based on domestic tax law. So these kind of shifting from one jurisdiction to other jurisdiction for the purpose of getting a tax benefit became prevalent, which is popularly called as treaty shopping, which has been there more than 25 years ago itself. These concepts keep emerging. These things keep emerging, due to which tax authorities were in a position they had to enact a lot of anti-avoidance provisions. That is the background these are the background through which the anti-avoidance provisions started to feature in the Income Tax Act and even the tax treaties. So one of the key provisions which has been made effective with April 2017 is the General Anti-Avoidance Rule, or GAR. These anti-avoidance provisions have been incorporated in the Income Tax Act, Chapter 10A of the Act. So what has been provided in this GAR provisions is that if at all an agreement is an impermissible avoidance agreement, then it has its own consequences. Then consequences have been prescribed. So now the question that arises is, what do you mean by impermissible avoidance agreement? So first question is what is an arrangement that leads to impermissible avoidance agreement? There are the word arrangement has been defined in the Act, and arrangement has been quite widely defined, that any transaction, operation, scheme, agreement, or understanding, whether it is an enforceable or not in accordance with the law, any alienation of property, any scheme, arrangement, understanding, merger, so it has been kept very wide to cover a lot of things in its ambit. Then when do I say that such arrangement is impermissible avoidance arrangement? That's the next question that comes. So again, that is also defined, which says that the main purpose of such arrangement is to obtain a tax benefit. So what do we refer to as tax benefit at this stage? Again, tax benefit has been defined to include many things, like any reduction or avoidance or deferral of tax or any other amounts payable under the Income Tax Act, any increase in refund of tax or any refund of any other amounts under the Act, reduction or avoidance or deferral of any tax or other amounts which would have been payable under this Act or as a result of a tax treaty. Thus, even if you get any benefit under the treaty, even that is covered under the ambit of GAR. Then any increase in refund of tax or any other amounts, either for the taxpayer itself or to any other person. Then any reduction in the total income or any increase in loss. All these, whatever is possible to be done and to get in the Income Tax Act, all those have been covered under the ambit of tax benefit. So when I enter into an impermissible avoidance agreement with the main purpose to obtain a tax benefit, then it is not permissible and it has its own consequences. Then certain things there are certain criteria also have been given illustratively, not that these are exhaustive. They have just given some illustrations that this arrangement may create rights or obligation which is not generally arise in a transaction that is carried out at arm's length. Means any transaction that is between any third parties. And such transaction may result in abuse or misuse of any provisions of any benefit that is available under the Income Tax Act. Then the transaction lacks, or it is deemed that the transaction lacks commercial substance, or if the transaction itself is undertaken for some purposes which is not generally considered to be bona fide. These are the illustrative criteria that have been prescribed. So one of the limbs that is given here is that the transaction lacks commercial substance. Again, the Act also tries to give illustrative definition for when can it be said that the transaction lacks commercial substance. For example, if the substance of the transaction and the transaction, either the part or whole of the transaction, significantly varies from each other, or it is inconsistent with the overall objective of the transaction itself, then it also includes round tripping of finance. Like you send the money out of India to some entity or to some setup, then you try to bring it back to India through some arrangements, or you do an accommodating party. You be an accommodating party for some transactions that happens, or there are some elements which actually offset or cancel each other, but it is purported to be a particular arrangement or transaction, or a transaction which is conducted through one or more person and it disguises its value, location, source, ownership, etc. The transactions basically lacks transparency of all the aspects that are there, or the transaction is entered into such a way that there are some locational benefits are derived out of it. Say, for example, there may be an asset may be located in particular jurisdiction. The reason why it is there, there is lack of commercial reason for why that particular asset should locate in that jurisdiction itself. Or what happens is some transaction which does not create a proper business risk or cash flow risk, which will generally be expected in a normal business scenario. These are all illustrative list when a transaction can be told to be lacking commercial substance. So, in case the income tax authorities say that there is some impermissible avoidance agreement, or even tax audit is required to comment on whether there is any impermissible avoidance agreement has been entered into by the company in Form 3CD. That way, if any permissible avoidance agreement is found, then what are the consequences for it? Again, the consequences have been prescribed in a very wide way. Like, say, for example, if you make the investment in particular form, say as equity or as a debt, that can be recharacterized into debt or equity, or your certain part of transaction can be disregarded, or two legs of a transaction can be combined, or steps or parts of your transactions can be recharacterized. Then in where there are multiple structures, the group structure is in such a way that there are multiple entities are there, the structures may be disregarded, or a look-through approach may be taken. Meaning, generally, where there is no avoidance is there, we say that each and every entity is a separate legal entity. Even though, for example, even though a company may be a wholly owned subsidiary of another company, we don't treat both as together. We say the subsidiary is a different legal entity and its parent is a different legal entity. But if there is an impermissible avoidance agreement, there is a possibility that the look-through approach may be carried out to say that both are same entities, etc. Then the actual place of residence of any entity or situs of particular asset or transaction, where the transaction takes place or where an asset is actually located, these can be changed by the tax authorities. Or what they could also do is they can also reallocate certain income, expense relief, etc. Then the classification of transaction as to whether it is revenue or capital could be altered, and any expenditure reduction, relief or rebate can be recharacterized as well. Thus, the possible consequences that have been prescribed is also exhaustively prescribed in such a way that it can extend to any extent. So basically, the idea is that it is advised that everybody has to deter from doing any avoidance activities. these such a strict provisions and such a strict anti-abuse provisions have been enacted. So when we say this, one particular question always comes up. Apart from this general anti-avoidance rules, there are always other specific anti-avoidance rules enacted in the Income Tax Act. Say, for example, we have Section 94, subsection 8, where if we acquire some shares or units, etc., some securities just before the record date for issuance of bonus shares. If you do that, and then once you are allotted the bonus shares, you try to sell part of your investments, probably the investment which you made by yourself originally, you try to sell it for a lower amount and try to book an artificial loss for the purpose of tax. Then such loss is totally disregarded. These are like this. There are even other specific anti-avoidance rules that have been included. Say, for example, you have the provisions of Section 50C, where it says that if you sell your land for an amount that is quite lower than the fair market value, something like a stamp duty value, then that be the case, they deem the stamp duty value to be the transaction value to be considered for the purpose of computation of capital gain. Like this, there are a lot of specific anti-avoidance rules that have been incorporated in the Act. So what happens in a case where specific anti-avoidance rules have been enacted? Will GAR also operate, or will specific anti-avoidance rules takes precedence and GAR should not apply? So what happens to that? That's the question that comes up. CBDT had issued a circular in 2017, circular number 7 of 2017, which clarifies that the application of GAR need not be affected by SR, which means GAR can also apply to a transaction for which SAR has been enacted. Both can coexist. Recently, within the past 1 year, we also have Telangana High Court's ruling, which also confirms this aspect that SAR doesn't necessarily, if SAR applies, it doesn't mean that GAR cannot apply. GAR may also be applied. That's the thing that is emerging out of these, both the circular and the ruling. So we need to keep in mind on particular this aspect as well. So this, as we discussed, this GAR has been enacted in the provisions of the Domestic Income Tax Act, which means it applies to any transactions which is under the purview of that, whether it is a domestic transaction or an international transaction. Since it also has relevance to international taxation and it has a lot of interplay, I started with it. So now I will try to dwell deep into specific aspects in relation to the DTA, the double taxation avoidance agreements that have been in place. We are all aware that the structure of taxation is twofold, that the countries try to tax the global income of the residents, and that is on one part. Other part, they also try to tax the transaction for which the source is in their country. Say, for example, if there is an Indian resident, the global income of such Indian resident is taxable in India. Even if he has earned some income in, say, US, Australia, any country, that is also taxed in India. Whereas, say, for example, in case of a non-resident, if he is earning certain royalty or a fee for technical service from India, that is also taxed in India. So taxation, generally, couple of things that frequently form as a base for taxation is that one is residence-based taxation, another is source-based taxation. So most of the countries follow similar pattern, due to which what happens is it leads to double taxation. A same transaction, same income may be taxed in both the resident country and the source country. So to avoid this double taxation, the double taxation avoidance agreements, DTA, DTAA, are the tax treaties entered into by the government of India with many other countries. Having this DTA also in place, we always used to have an issue that used to come up is like that somehow the tax base is eroded. The tax base is not protected and tax is not paid in all the countries in a fair and equitable way. One example that we saw is the treaty shopping. Totally just for the purpose of tax. They try to move to a third country and then try to operate from there without any substance in that third country. So, like this, there were many issues were cited on account of this operation of double taxation avoidance agreement, due to which the OECD came up with various action plans to prevent this base erosion and profit shifting. One of the major initiatives under that BEPS was that let's certain reforms be made through an instrument called multilateral instruments. So basically, what this multilateral instruments is that, say for example, India now, if I say India has a double taxation avoidance agreement with more than 180 or 190 treaties. If I were to make some amendments to these treaties, I need to go and negotiate with all these countries and do the amendments one by one. 190 amendments I will have to do. Instead, what the framework of MLA tried to achieve is that through once a couple of two countries say confirm that they are parties of MLA and they choose what are all the amendments in treaty that they want to subscribe to, they can do so. And whatever they want to choose, they will just declare it and then they will give an effective date for it. Once two countries have chosen this, then whatever amendments they have chosen, that will have to read into the particular double taxation avoidance agreement. By this framework, each of the countries tried to subscribe to this MLA, with their option as to what are all the provisions that they want to subscribe to, through which these say for example, if India say subscribes to MLA, then all the treaties that India has entered into with all the countries, these aspects could be applicable. That's how they tried to simplify the process of treaty negotiations and amendments. And all these amendments were majorly to ensure that there is no base erosion or profit shifting. So I will just there are few anti-avoidance provisions which were incorporated through these MLAs. So I will get into those now. So very fundamental shift is that earlier the preamble of our DTAA or the tax treaties used to say that the purpose of this agreement is for avoidance of double taxation, and is basically that used to be the purpose stated. In certain treaties, say for example, India-Mauritius Treaty, they had also included that this treaty is also for the purpose of encouragement of mutual trade and investment. In the landmark judgment of the Supreme Court in Azadi Bachao Andolan, Supreme Court had also pointed out this. They had considered this preamble and said, if this is the objective with which a treaty is entered into, they tried to evaluate whether it is totally is tax avoidance. Is it even a tax avoidance? Whether it is even an objective of this country? They try to evaluate and then give this judgment. They had taken into account this particular class also. So this was the position earlier. Now Mauritius Treaty has been amended. So now it is, as of today, this particular encouragement and all are not there. So and how has the shift happened from such a preamble to current state of, say for example, where MLA has been subscribed to. India has subscribed to MLA. I will just make that clear first. So what happens is that so any double taxation avoidance agreement to which MLA is applicable and both the treaty partners have agreed for MLA is called as covered tax agreement. What do I mean by covered tax agreement? This is what this. So hereafter I will refer to as covered tax agreement, which means DTA to which MLA is also applicable. Okay. So this when MLA is applicable, one of the key amendments made is that the preamble is modified. The preamble is modified to say that while the objective is to eliminate double taxation, at the same time objective is also to not to create any opportunity for a tax evasion or avoidance. This particular objective is also clearly spelled out even before we get into the treaty by way of MLA. So I will just go. So what happens is that the context as to what the treaty object is, what the treaty. So this particular part of the preamble has to be read along with as we go and dwell into each of the class in the treaty to determine the tax implications, etc., in respect of the transaction that we may enter into and for which the tax implication we are looking at. So the preamble itself is a significant shift. Then I will go to there are two key other provisions that have been made through MLA. I will dwell upon into one of those now. One of those is that principal purpose test. So what does the principal purpose test, our principal purpose test provide is that principal purpose test provides one is not eligible to avail the treaty benefit if, based on the facts and circumstances, one can reasonably conclude that one of the principal purpose of the undertaking the transaction itself is to obtain a tax benefit. Similar to the domestic GAR, but we can contrast also. We can compare and try to contrast also, which I will do slightly in subsequent part of this discussion. So again, treaty is also clear that if you are carrying out certain arrangements or transactions only to avail the treaty benefit, or one of your principal objectives is that, then sorry, we are not intending to give you the treaty benefit. You are not eligible for treaty benefit. This is the major crux of principal purpose test. Any transaction that is entered into, any arrangements that happen, test what is the principal purpose of getting into this arrangement. Is it to obtain a treaty benefit? If yes, then the principal purpose test fails because you are trying to obtain tax benefit. So treaty benefit is not available for you. However, there is a key exception to this. What is the key exception? In case, if I say that the very object and purpose of this treaty itself is to give a treaty benefit to such a case of the facts that is given, then you are safeguarded from the purpose of PPT. Okay. If the object and purpose of tax treaty itself is to give relief in certain circumstances, then such circumstances cannot be hit by the provisions of PPT. Okay. So with this introduction of PPT, what has really changed? What has happened? If we look at it, either this PPT or there is one more class which we will be discussing subsequently, which is called limitation of benefits. These two classes have been incorporated by most of the countries, and these are part of many India's covered tax agreements. So unless the other treaty partner has not subscribed to MLA, or except for those, all other agreements, this MLA will become applicable. This PPT and simplified limitation of benefit class will be applicable in all such treaties. So India has chosen the most key anti-abuse provision, that is this PPT, in all its covered tax agreements. Then, so what happens is that further to this amendment, CBDT has also issued a circular in which some of the key aspects have been clarified. What has been clarified is that this PPT provisions applies prospectively, meaning there is a date of applicability from which this MLA gets into effect, which is based on the date in which I choose to subscribe, the date in which the treaty partner used to subscribe. Based on this, the effective date is decided. So this PPT will be applicable only from the effective date, meaning any transaction that was entered into in the past, which may be still under litigations, may in various forums, etc. For all those cases, the PPT will not be applied. Then there are few further to MLA. India also tried to make amendments to certain treaties, like treaties with Cyprus, Mauritius, Singapore, etc., were amended through bilateral negotiation, through discussion and finalization with these countries, wherein some grandfathering provision was provided. Like, say for example, Singapore Treaty provided that if you satisfy some condition, the capital gains from sale of shares of an Indian company is exempt. Earlier provisions I'm talking about. It was the provision till 2017. So a grandfathering has been provided that if you had acquired the shares before the date, before 2017, then you are still grandfather, and the old proviso of exemption still applies to you. However, if you are going to do a new investment during the current period, then the amended provisions which provides for taxation of capital gains will be applicable for you. In these treaties, this specifically grandfathering has been provided in these treaties. So, in respect of these three treaties, where the grandfathering provision is sought to be applied, the department will not try to apply PPT and deny such treaty benefits. Whatever grandfathering has been provided in these treaties, that will still continue. This is the clarification that has been provided in the CBTT circular. So these are the key features of PPT. In the ensuing part, I will try to compare GAR and PPT, and we will try to understand the similarities and the differences also. So before I move on to that, in the PPT itself, there is a recent case law that came up also. Let's have a look into that also, so that it will give us a flavor on how the PPT is practically looked at. In the facts of this case, an entity is set up as a limited liability company in Luxembourg. This entity is registered as FPI with SEBI of India. This particular entity, this Luxembourg entity, earned income from its investment in India, investments, various securities in India. What had happened is, in the fact is that this particular Luxembourg entity was wholly owned by an entity in Cayman Island. Again, such entity which was there in Cayman Island, the ultimate holding entity was also in Cayman Island. That ultimate holding entity used to get funds from various investors globally. It pooled and then it passed on to respective entities, and that's how the funds came to Luxembourg entity, and Luxembourg entity made investments and made income out of this investments. So the income tax department argued that just the Cayman Island entity tries to do a TT shopping by getting into Luxembourg in order to get the benefit between India-Luxembourg treaty. They said that the TRC alone, while they have provided the TRC of Luxembourg entity, TRC is tax residency certificate issued by a tax authority of that country, saying that yes, this particular company is a resident of this country, they file tax returns here, etc. Such TRC alone is not a sufficient proofs to establish the tax residency. They also tried to make a comment that there is no commercial rationale why they chose an entity in Luxembourg to make these investments. Assessee is not beneficial owner of the income. I will also touch upon the concept of beneficial ownership in the ensuing part of this discussion. For the time being, the contention made by the department is that he is not a beneficial owner. So, Income Tax Appellate Tribunal, Delhi Tribunal in this case, they looked at various aspects how this Luxembourg entity has been operating. This Luxembourg entity was established in, the facts were like this. All these facts have been considered by a tribunal. This Luxembourg entity was established in the year 2025, and it has been continuing until 2023, and it has been holding several investment not only in India but in various jurisdictions. TRC, which is one of the basic conditions for availing the treaty benefit as prescribed in the Income Tax Act, has been complied with. Revenue has not been been able to give any cogent reason as to why the validity of TRC should be doubted. They have not told like that entity is just a shell entity, it does not have anything, it does not have any address, nothing like that is they are able to come up with. So they are not able to come up with any such facts. Then the assessee is income that it earned from India and from lot of countries have been offered to tax in Luxembourg. They had filed their return in Luxembourg. They had a proper office in Luxembourg. They had incurred lot of expenditure, like whatever expenditure is required for making investments, like say investment consultancy, investment related expenditures, then actual physical office, rent paid to that physical office. There were a lot of expenditure incurred in Luxembourg. These facts goes on to establish that the Luxembourg entity actually operates these investment activity out of Luxembourg, and they are not just an entity which does not have any substance in Luxembourg. So considering all these facts, it said that this entity is a standalone entity. It does not depend on the holding entities for its investment activities. Like it has sufficient manpower or director, etc., who can take decisions by themselves in respect to where to invest, etc., etc. So The substance of this Luxembourg entity is clearly established based on all these facts. Then this also holds substantial investments. This particular investment, this Luxembourg entity holds investments. It controls the assets and investments on its own. It is not bound by anything from a person in Cayman Islands or anybody. So the principal purpose test is satisfied. Their intention is not just to take tax benefits, and it is not just with India, it is doing with various other countries also. So the tribunal concludes that PPT is satisfied and that the company should be eligible for treaty benefits. There is no rejection of treaty benefits on the account of PPT. What is the conclusion of this? So with this, it becomes clear that wherever there is a transaction between two entities, you always look at the substance of what happens, what is the functions performed by each of the entities, what are the assets employed by them, what is the risk borne by each entity, are there genuine transactions, have these been evidenced through communications or other conduct, etc. And then based on that, the decision is arrived at. Objectively, the decision is arrived at. Yeah. So now I will try to compare and contrast GAR provisions and PPT provisions. Key differences that we already know is that the one thing I will highlight is the language. The language in GAR was that the main purpose is to obtain a tax benefit. In case of PPT, it was one of the principal purposes, which means PPT is quite slightly more wider. If one of your purposes is to obtain tax benefit, PPT can be applied. But for GAR, the main purpose, the most important purpose itself should be obtaining TD benefits. So this is one difference in the language which we try to derive from. Then second thing is that what is the consequences of GAR? Consequences of GAR, as we discussed, is quite wide. The income tax authorities have gained power to introduce many implications to the GAR, whereas PPT is limited to denial of treaty benefits. Treaty benefits should not be available. All your transactions will be taxed based on applicable domestic acts. That's all. There ends the role of PPT. Whereas if GAR is invoked, it has many implications as we discussed in detail some time back. However, there are certain key differences also. Like any income that is earned before 1/4/2017 is not subject to GAR. However, if any arrangement was entered into before 1st April 2017, but the tax benefit is obtained after 1/4/17, still GAR can be applied to such transactions. In case of PPT, there is no general grandfathering except for what we discussed in 3 treaties like Cyprus, Singapore, and Mauritius. Except for that specific grandfathering given in those treaties, there is no other grandfathering given. Prospective application has been clarified. Then, in case of GAR, there are a lot of procedural formalities also. Like, in case the income tax authorities try to invoke GAR, they have to refer, the assessing officer first has to refer the case to a panel of commissioners called GAR panel. They should take their approval. Then again, when such GAR panel tries to decide, they should give an opportunity to the assessee to present his case, takes that into account. Then only they should grant the approval. Once the approval received, only the assessing officer will be able to invoke GAR. All these safeguards have been, since the implications are very severe, safeguards have also been procedural safeguards have also been enacted for invoking GAR. Whereas for PPT, no such requirements have not been prescribed till now. Then GAR applies only if the aggregate tax benefit to all the parties from that transaction exceeds rupees 3 crore, threshold of 3 crore in a particular year. If the total tax benefit of all the parties from a transaction is less than 3 crore in a year, then GAR cannot be invoked. However, for PPT, no thresholds are there. PPT can be applied for any amounts. Then CBDTs are rules. The rules made under GAR also clarifies certain aspect that GAR will not interfere in the right of a taxpayer to choose method of implementing a transaction. For example, say if I have an entity I have an entity in which I need to infuse funds. That entity has to, for its functioning, I need to provide the funds. I have a choice either to give it as an equity or as a debt. GAR will not say either should I use equity or debt. It's a different matter that there are specific anti-avoidance provisions like thin capitalization rules, section 94B, all those are there. But GAR will not interfere on this choice where the choice of implementing transaction is available to the assessee. One more example that we can look at is, should I say if I have a cash surplus in my entity, should I give it as pass it back as a dividend? Should I do a buyback? Should I do a capital reduction? All these are various choices available to me, but given to me by virtue of various legislations like Companies Act, etc. GAR will not intervene as to what should I choose amongst these. Then, in case of a choice of jurisdiction, like we discussed for the Luxembourg entity, if the choice has been made due to consideration other than a tax consideration, like say there could be a lot of commercial consideration also, like the proximity of the particular location, maybe availability of expertise in that location. There could be various other commercial reasons for choice of a jurisdiction than tax reasons. In case it is established that the reason for establishing doing a transaction through particular country is due to a commercial reason, then GAR will not be come into place in for such transactions. Or in case of scheme of arrangements, say for example, scheme of amalgamation, lot of other scheme of restructuring, etc., can be approved by court. If the court has explicitly and adequately considered all the tax implications arising out of such schemes, then GAR will not interfere in this. These clarifications have been provided. However, there are no clarifications on this front when it comes to PPT. These are the key differences between GAR and PPT. Then let's also look at the interplay between GAR and PPT. Okay, so in a general context, where there are two provisions, one in the Domestic Act and one in the Double Tax Avoidance Agreement, the one which is most beneficial to the taxpayer or the assessee is generally applicable. However, GAR is an exceptional provision that even though GAR is not favorable to the assessee, still GAR can be invoked if it becomes an impermissible avoidance agreement. As we saw, GAR is very subjective. There are no clear bright line test kind of, they are not saying, like they are not given a clear criteria like say you should have 50% of this amount should not exceed this threshold, like that there are no specific amount. So it makes the process a bit subjective. And the scope is too wide. The scope is too wide when it can be invoked. And the scope is, consequences are also too wide. And the consequences can be applied either to the whole of arrangement or it can be applied to a part or a step in an arrangement, etc. So the powers given under GAR is very wide. But however, as I told you, the safeguard has been given, like a panel has been constituted with senior tax officials who have to scrutinize and approve it, etc. Okay. However, there are no exact judicial precedences which clarifies what are the contours of GAR, what is the ambit in which the GAR is to be applied. How do we interpret the provision? How wide do we interpret? Or it has to be, should it be read in a bit restrictive? No judicial precedents actually touch upon this area till now. So what happens? So there could be some cases where GAR is not triggered, but still PPT can be triggered. Similarly, there can be some cases which doesn't fall within the ambit of treaty, but again, it can be dealt with by the GAR, etc. So what is the fallout? I have been discussing so much about GAR and PPT. What is that? Something which I can give you as a takeaway is that nowadays, after this GAR, PPT and all are in place, it is extremely important to have sufficient documents, have sufficient documentation of the rationale of any decision taken. Now it has become extremely important so that you will be able to prove as to what are all the factors which have been gone into consideration before a particular decision is taken. For example, So as we discussed earlier, an investment has to be made in India. From which country do I make such investment? Should I do it through Singapore? Should I do it through my home country itself, or should I do through some country? The decision should be driven based on commercial factors. For example, there could be availability of skilled labor, legal system, political stability, banking systems in that particular jurisdiction, or the structure of the group in such a way that APAC is a particular region from which all other investment will be made. There will be an headquarter for APAC. From such headquarter, all investments in other Asia Pacific countries will be made. Like that, there may be some group structure that may be in place. Or there could be a history of investors' legacy and business ecosystem where they are already familiar. They already have, say, vendor supply chain or customer base, etc., etc. Or the shares, assume I go and list my shares in particular jurisdiction. Then it also, in a way, establishes my commercial rationale in a stronger way. Then, whenever I carry out transaction like incorporating an entity, etc., always ensure that that entity really has some substance. It is not just an address or a post box or a non-existing entity or entity that does not have anything. No, don't do any transaction in such a manner. Ensure that it has its own office. Ensure it has adequate space so that it can accommodate all its employees. Ensure it has actual employees sitting out there who carries out all the activities that are required to be carried out. Ensure it has proper business expenditure. Ensure it has a proper management who sits out of there and does it. If you are doing investing activity, ensure that are you doing it only for one jurisdiction? Are you doing globally? All these factors, consider it. See to at the planning stage itself, ensure that all these have been considered, and enough documentation is also maintained for any decision, any commercial or operational decision that is carried out. Mere resolution that so and so decision has been taken, it is approved by the board, may not suffice. The board may have to take on to record various other things that have been considered by the people who are at the junior level. It has to take all those on to record, put it in the part of minutes, etc., so that it becomes easy for the assessee to prove things at the later stage. This becomes very critical. This is what I would say is my takeaway from this entire session itself. So with this, I will move on to the next feature of the MLA that is incorporated in respective treaties, which is limitation of benefits. India has obtained has exercised the option for simplified limitation of benefit. Under simplified LOB, what happens is that specific criteria have been prescribed, and only if you fulfill these specific criteria, you will be able to avail specific treaty benefits. Say, for example, if I say that a particular lower tax rate for capital gain is applicable, that is applicable only if you satisfy 1, 2, 3 criteria. Like, even the owners of your country, more than 50% of the owners of your company should be in the same country. That is an example of a LOB class that is incorporated in one of the countries. Say if you are a company whose share is listed in that particular exchange, yes, you tick the box for one of the LOBs. Like that, specific conditions have been prescribed. If you satisfy those, you are eligible for some certain benefits like lower tax rate, etc. If you don't satisfy, you are not. These conditions are often based on these substance requirements that I told you. Like they say, are there employees? Is the kind of entity incurred business expenditure in the past? In case of dividend, has the entity at least held the investment for 12 months or more? All these conditions have been described as limitations of benefit. You satisfy the conditions, you get so and so benefit. If you don't satisfy, you are not entitled for that benefit. One good thing about this LOB is that mostly it is specific bright line test, meaning it always gives a specific threshold like 50%, so and so amounts, this number, etc., has been prescribed, so that it becomes relatively easier to see whether those have been met or not, as compared to subjective things in GAR or PPT. MLA is generally allows the respective countries to implement either of PPT SLOB or combination of these. As I told you, India has opted for PPT and this simplified LOB. This is what I had to discuss about LOB. And next, there are a couple of other aspects that are the fallouts of MLI. I will try to run through quickly. While I made the presentation a bit detailed to cover a lot of things, I will just try to touch upon the crux and move on. So in the interest of time. So one of the concepts that is there is beneficial ownership. So beneficial ownership provisions feature in many of the treaties. For example, if there is a royalty or FTS or any passive income, they always provide that the recipient should be a beneficial ownership, should be the beneficial ownership of the income in order to apply the treaty benefits. What do we mean by the beneficial ownership? Meaning that wherever some income is earned, that entity which is earning the income should have constrained rights to enjoy that income. In other words, it should not receive it in the capacity of an agency and passing it on to somebody else. It should not have an obligation that it has to pass on some amounts to somebody else, etc. Only then you will be able to get that benefit. This is again the condition of beneficial ownership is mostly incorporated in many treaties, particularly in the passive income classes, the class which deals with dividend royalty, etc., dividend royalty, interest, FTS, etc. It specifically says only if the recipient is beneficial owner of such income, they will be able to get the treaty benefits. Otherwise, it is not available to them. So there are a couple of aspects. That is that there is one particular treaty, CBDT circular, which provides that TRC itself is a proof. TRC itself is a sufficient proof to prove the beneficial ownership as well. So again, this particular circular has been considered by many courts, including Supreme Court in the landmark judgment of Azaz, Bachao, etc., when assessing the beneficial ownership. Anyway, when we look at the recent judicial trends, what happens is that while TRC's validity is upheld, the need for look-through approach, where the entities doesn't have a proper substance, etc., is also discussed in the judgments here and there. Not that they blindly rely on TRC and say the moment TRC is there, beneficial ownership is there. They also put the onus on the revenue to prove that there is no beneficial ownership otherwise. Again, I have just listed out many judicial proceedances in the context of beneficial ownership, which have been there till now, which may be referred to when required. Just to sum up, that as per the CBDT circular, treaty itself is sufficient to prove the beneficial ownership. However, Indian courts appear to be open to a look-through approach in case there is some lack of substance, etc. However, the onus of establishing such need for look-through approach is put on the court of the revenue. The ball is put on the court of revenue to prove that. Again, when we look at this is again a very important aspect. The treaties, they prescribe the beneficial ownership condition for certain scheme of incomes like dividend royalty FTS, where yes, it is required. But there are few articles like capital gains, etc., where the treaty language does not require the entity to have a beneficial ownership. That be the case, do we have to say that even there beneficial ownership is required? The courts have mostly said no, it is not required unless other anti-abusive provision like PPT, LOB, etc. are not satisfied. Unless that is the case, you don't have to read the LOB, read the beneficial ownership requirement into such class for the sake of where it is actually not explicitly provided. So these are the key concepts in the beneficial key anti-avoidance provisions as applies to international taxation. A couple of aspects that again I will quickly touch upon is that earlier what used to happen is that this is most common in the case in the setup of in the MNE setup, multinational entity setup, the entity that is there in a foreign country, it may not really have any presence in India. Just that the Indian entities, employees, etc., they could go on to do a lot of activities on behalf of such foreign entity. Say, for example, they negotiate the contracts, they try to enter into contracts, etc. So, while these agency arrangements, while these creates a kind of permanent establishment in India. However, it used to go untaxed because of there were no relevant provisions in that. But by the virtue of, they always used to say the signatory is not there in India. Signatory always sits out of India. Who is signing the contract? Later, the MLI introduced these provisions to say that even though somebody is not signing the contract in India, as long as somebody, as a habit, as a routine, tries to conclude the contract in India, or they habitually play a principal role in conclusion of the contract, principal role which leads to conclusion of the contracts in a routine way. Any contract that they play a real role in, that is not principally modified in the foreign by anyone sitting in the foreign country, and they just execute it. These fact pattern also emerges. Then in that case also, it could constitute a agency PE in India, and you have to attribute profits to the PE and then offer the required amounts of tax. While this is one of the, while this is the class in P, this is the class in PE. This similar language is also employed in significant economic presence, business connection language in the Income Tax Act itself. That is also something which we should keep in mind. So always, wherever the activities in India tries to go beyond marketing, like negotiations, entering to contract, playing a principal role, etc., somebody has to be careful to see to it that they see what actually happens, see to it that required, if there is a PE, establish the PE, then offer the required amounts of taxation, etc. So one key question that used to come up here frequently is that assume that this particular transaction is already remunerated at arm's length margin, at arm's length price. Say, for example, such negotiation activity and all is carried out by India, but India is paid relevant remuneration by the foreign entity. Does it suffice by itself? Because some comments on these lines were made by Supreme Court in the case of permanent establishment, in cases like Morgan Stanley, etc., the landmark judgment again in the context of PE, whether that still applies after this, or there are aspects like whether an amount, what is attributable to it is already determined, but what about the tax implications of it? Say, for example, if I say I don't have a PE, I may be taxed on gross basis based on the provisions like Article 12 or Article 13 of DTA, etc. Whereas if I say I have a PE, then I have to compute the net profit, and tax rate could be 35% on net profit in that case. So all these are a bit open-ended, not that we have conclusive answers for this, but all these are questions that are emerging in the field as of now. Yeah. So I will just quickly touch upon a couple of other concepts. One is this splitting up of contracts. What happens is that there is one particular type of PE, which is construction or installation PE, where they say that if your activities in India for construction or installation projects exceed a certain threshold, like say 9 months or 12 months, etc., then you constitute a PE in India. You have to attribute income to that PE, pay tax on it. What happened to is there is to be artificial defragmentation. Like they used to say some is only preparatory or acceleratory. It's not really real construction or in the work. Or they used to break it to different related parties and give the contract to different related parties in such a way that none of them satisfy this given threshold of 9 months or 12 months, etc. Again, what has happened is post MLI, they have told that even if you do activities connected with that project, even that needs to be taken into account. Which when it exceeds 13, that needs to be taken into account in order to establish whether construction PE is not or not. Then to determine whether some projects are connected or not, while it is fact and circumstances based, some parameters have been laid down. You do all these tests, And if these tests are satisfied, then you say it is connected. Accordingly, you see whether P is constituted or not. So this is what has come up in splitting up of contracts. Yeah, I think I will conclude my presentation with this, and I'm open for any questions. Hello? Yes, sir.
Thank you, sir. This was wonderful session. Today we heard about how to interplay GAR and PPT, GAR versus PPT, simplified limitation and beneficiaries, beneficial ownership, agency arrangements, etc. In detail guideline we heard about this. Thank you so much. I think there is no query about this topic. This was wonderful session. Thank you CP committee. Thank you Satish Gupta sir, and thank you Vishnu Kumar Agrawal sir, Vice Chairman CP Committee, BB Satyamurthy sir, wonderful speaker, Miss CA Chunoti ma'am, she also explained in wonderful manner. Thank you to all and all the audience. Thank you so much. Today we are gathered more than 500 members as an audience. Thank you so much to all of you. Thank you Akshat sir. Thank you Ajit Nath
At
sir.
last, thanks to you, Ashish Jain ji, for
Thank you so much sir.
wonderfully
Thank you.
moderating today's session.
Thank
Of
you
course,
so much,
to
sir.
Satyamurthy ji, Chinoti madam also. So, from on the behalf of the committee, I would like to say thanks to each one of you, to the faculty Satyamurthy ji, Chinoti ji, Ashish Jain ji, for wonderfully moderating today's session. Thank you, Ashish ji.
Thank you, sir.
And of course, to all the members who are watching this from last 2 hours. Thank you, sir.
Thank you very much to the CPE
Thank you,
committee
sir.
and
Thank you, sir.
all your support and the attendees as well. Thank you so much.
Thank you, sir.
Thank you, both the faculties and the Ashish sir.
Thank you, sir.
Yes.
Recording stopped.